Welcome, traders. Most volatility indicators react too late. ATR alone lags, and Donchian channels wait for price to make a new high or low. But what if you could detect volatility shifts before price actually breaks out? Today I'll show you how the CUSUM Volatility Breakout indicator does exactly that on BTC USDT. The core idea behind this indicator is simple. Instead of looking at volatility after the fact, it measures cumulative drift, the small up or down changes that gradually build pressure behind price until the market breaks. Let's add this indicator to the chart. Make sure you're on BTC USDT, 4-hour time frame on the Binance Exchange. Go to Indicators, type in CUSUM Volatility Breakout. Select the indicator to add to the chart. Open the settings. You'll see the difference price series section. This is the difference in price from the previous bar, which transforms the data to a stationary series in order to process it on the CUSUM control chart. Then you have the CUSUM parameters. Let's look at the CUSUM input mode. This one selects the transform data of the price series, or you can select the residuals, which is the residuals of smooth price difference. You can also select volume-weighted CUSUM, and this helps to avoid signals with low volume periods. Next, we'll look at the K parameter. It represents how big a shift in sigma units you want the chart to be sensitive to. This filters noise. Higher values make the indicator less sensitive, fewer signals but more reliable, and lower values make it faster but noisier. And next we have Hmax. This sets how far the drift must move before a breakout triggers. Larger values mean fewer, bigger moves. And then you have the change percent. This dynamically adjusts H between its min and max value based on volatility. And then finally we'll go down to the chart visuals and styling, and you can select the different trade directions, both, or long, or short. And for this demo, we're going to keep it on both. There are other adjustments that you'll see throughout the Settings tab. All of these help to filter out the data to obtain the right settings for your indicator. These other adjustments are all explained on the indicator page itself, and I encourage you to review this as it is a wealth of information on making the most of this indicator. Well, here's how it works. You load the indicator on the chart, and then you identify inflection points in the market that show the reversals. Here you can see the different trend directions and their inflection points. So you want to configure your settings in the indicator to trigger on these market inflection points. You'll see we caught as cumulative price builds, it'll cross the upper control limit. You'll see the signal here turn green, and you'll see the marker to enter long, exit short. And then over here, you'll see the cumulative price build up till it crosses the lower control limit. So you'll see a red dot. That's the signal, and the marker to exit long and enter short. Notice there are two areas down here in the chart that show there are small periods of time when there's an intermittent reversal. They don't really reflect that in the overall price action, so we want to filter those out. So we're going to use the Bollinger Bands to do that. We'll enable it and adjust the parameters to filter those out. I missed one here. $45. There, that captures it all. Here you'll see the cumulative price break down below the lower control limit and confirmed by the Bollinger Band triangle here. And the markers to enter a short at this point. And then you'll see where the cumulative sum price breaks above the upper control limit here. And in order to capture this confirmation, we had to go back 43 bars, which is what we did right here, 45 bars. That captures this inflection point for the move upward. And then here, the cumulative sum breaks again beyond the lower control limit, confirmed by the Bollinger Band breakout indicator here, the triangle. And that's where we enter a short. Now, before we accept all of these settings, we want to confirm that our transform data is indeed stationary. We can do that by processing the data through the augmented Dickey-Fuller mean reversion test to ensure that it is stationary. Go to Indicators and type in augmented Dickey-Fuller mean reversion test by TBTKG. Add that to the chart. We know we've got our length of 30 here. So we change this to 30. Select the price difference from our indicator, 95%, and we see we're all green below this line, mean reverting. It confirms that it is stationary. You can see from the results that the reward over risk ratios are decent. Here there's almost 2. You get a little over 4 here, and almost 2.5 here. So why use CUSUM instead of traditional indicators? Because it's earlier, it detects the regime change before price expands. It's objective. There's no eyeballing. The drift accumulates mathematically. It adapts, works in trending, ranging, or choppy markets, and it supports both directions. Breakouts up or down are treated symmetrically. A few things to keep in mind. CUSUM is powerful, but it's not perfect. If K is too low, you'll get noise. If Hmax is too high, you'll only see rare breakouts. And like any breakout system, it can get chopped up during low range periods. For most users, starting with the preset defaults works great. Then tune K and Hmax and the other parameters based on the asset's noticeable inflection points. If you want a faster and more objective way to detect volatility regime change, give the CUSUM Volatility Breakout Indicator a try. Thanks for watching, and I'll see you in the next tutorial.